Progressive tax. Let's cash in.
Finance for the everyday millennial. Hard charging solutions. We provide an accelerant in the journey towards financial independence.
Welcome back to Cassian with Cassian, the financial forum for young professionals. It's tax season, RINOs, and so I thought it would make sense to talk about tax rates in our progressive system of taxation. This is important information to know because it has a direct impact on each and every one of us who pay into the system. There are two basic ways of assessing taxes: a flat rate or progressive. A flat rate tax is a single rate that's applied to any taxable amount. Sales tax is a good example of a flat rate tax. If your area charges a 7% sales tax, then 7% is added to the total cost of anything that you buy, no matter how much or how little you spend. U.S. federal income taxes, the 800-pound gorilla in the tax world, are set up on a progressive scale that ranges from 10% to 37%. Each tax rate is known as a bracket. As the amount of income you earn increases, your tax rate also increases each time you outgrow a bracket. For 2022, there are 7 different brackets for the federal income taxes. They are 10, 12, 22, 24, 32, 35, and 37%. Since the tax rate is progressive, your income tax is calculated based on the amount you've earned in each tax bracket. A single taxpayer whose adjusted gross income was $75,000 last year would fall within the 22% tax bracket. Remember that federal income taxes are progressive, not flat. So the total tax bill is not based on 22% of $75,000. The actual tax owed is computed progressively on a sliding scale. For example, for the first $10,275 a taxpayer earns, they are taxed at 10%. Then the next $31,500 earned is taxed at 12%, and the last $33,225 is taxed at 22%. Taxing income at progressively higher rates means that you only pay the top tax rate on the portion of your income that falls within that bracket. The highest tax rate imposed on your income is known as your marginal tax bracket. The actual amount of taxes you owe will depend on your filing status, a number of dependents you can claim, and the amount of deductions that you can take. The Tax Cuts and Jobs Act of 2018 increased the standard deductions so the majority of taxpayers no longer need to itemize their returns. You can get a quick estimate of how much you'll owe in federal taxes by going online to the IRS website or consulting a tax preparation expert. But the federal government isn't the only entity in the income tax game anymore. States have realized that income taxes can provide a steady stream of dependable income, so most have adopted some level of taxes. Income tax details can get fairly complicated at the state level, so let's break this down. Is there any state that doesn't tax income? Yes. As of 2022, there are 8 steps that do not levy a personal income tax on their residents. Those are Alaska, Florida, Nevada, South Dakota, Tennessee, Texas, Washington, and Wyoming. New Hampshire does not have a state income tax, but they do tax residents on the amount of dividends and interest earned during a year. Is any type of income exempt from state taxes? Again, yes. Some states tax income during your working years, but take a pass on taxing Social Security, pension, or retirement savings. These include Alabama, Illinois, Mississippi, Pennsylvania, and New Hampshire. And it goes without saying that the 8 states that don't tax personal income tax also do not tax pension or retirement income. Do any states have a flat income tax rate? 9 states tax residents' income at a flat rate. These states are Colorado, Illinois, Indiana, Kentucky, Massachusetts, Michigan, North Carolina, Pennsylvania, and Utah. Flat income tax rates average about 5%. What about the other states? The remaining 32 states, plus the District of Columbia, have a progressive tax structure with tax brackets ranging from 0% to 14%. Generally speaking, state income tax rates tend to be lower than federal income tax rates. High tax states top out at around 14%, which is still much lower, about 20 points lower than the top federal tax bracket. What else should I know about state income taxes? You may be able to deduct your state income taxes on your federal tax return if you itemize your deductions. But consult a tax professional with expertise in your state to find out if this is an option for you. There are a couple of things you can do to minimize state income tax burdens. Members of the U.S. military, for example, can register a home of record in one of the states without an income tax to avoid any state taxes as they relocate from one posting to another. Pre-tax contributions to an HSA or FSA will lower your tax burden for both federal and state returns. Taking time to learn about the income tax laws for your state can help you uncover specific deductions that may help you save on taxes each year. If you're a typical tax-averse individual, and who isn't these days, you might be tempted to move to a state like Florida or Texas or Washington and escape paying state income taxes at all. But this may not be the best choice of action because what the government gives with one hand usually takes away with the other. Take Texas, for example. The overall cost of living in Texas is pretty much at or below the national average, making it fairly affordable to live. But Texas has the 7th highest average property tax in the United States, and taxes are assessed at up to 100% of the appraised value. In some jurisdictions, the owner of a home valued at $275,000 can expect to pay over $6,000 a year just in property taxes. Florida, on the other hand, is known for having low property tax rates and a generous homeowner tax exemption. But its economy is heavily dependent on tourism, so wages tend to be lower than the national average, while the cost of living is higher. Washington is known as a state that pays well, especially for tech sector jobs, but the overall cost of living is well above the national average, so incomes don't go as far as they do in other states. RINOs, when it comes to taxes, there are several pieces of advice that I offer to limit or completely eliminate your income tax liability. Hi RINOs. If you would like specific advice on decreasing your tax liability, please visit us at rhinoinvest.co and make an appointment with a financial planner today. Let's get back to it. For the purposes of the masses that are watching this show, I'll provide you with one piece of advice, and that is to have a good idea of what your annual income tax burden is and plan your payroll withholding to be as close as possible to the actual amount that you'll end up owing. Overpaying throughout the year might guarantee you a nice refund when you file, but that refund isn't exactly a gift back to you. It's a zero-cost loan to the government that's being returned to you. Think of it this way. Would you habitually send the electric company $30 more a month than they bill you for, then be happy to get $360 back a year later? No. If you keep your money in your pocket, you have the freedom to choose how best to save, spend, or invest it. As hard-charging investors ourselves, we always preach the opportunity cost of every decision, including limiting your tax liability in order to invest the maximum amount possible, as soon as possible. Until next time, this is Cassian reminding you that it's always a good time to cash in with Cassian.